Every investment risk level explained, very low risk. This is where protecting your original money matters more than chasing big returns. Treasury bills, CDs, and cash equivalents are common choices because they are designed to keep price swings relatively small. Think of them like parking your money in a secure garage instead of taking it onto a racetrack. The trade-off is simple: less potential growth in exchange for more stability. A treasury bill may pay you a predictable return when held to maturity, while a CD typically locks your money away for a set period. But low risk does not mean zero risk. Inflation can quietly reduce what your money can buy, even while your account balance grows. So this level can make sense for emergency savings, short-term goals, or money you cannot afford to see fall sharply. Low risk. Here, you are generally lending money to borrowers considered relatively reliable, often governments or financially strong companies. In return, you receive interest, which can make these investments feel more predictable than stocks. Government bonds and high-quality corporate bonds are common examples. Imagine being the lender rather than the owner of a business. You are mainly waiting to be repaid with interest. However, there is an important catch. Bond prices can move when interest rates change, so a bond investment can temporarily lose value even when the borrower remains financially healthy. Credit risk matters too, because companies can run into trouble. Low risk is not the same as no risk. You are accepting smaller potential returns in exchange for generally smaller swings, a trade many investors consider worthwhile when stability matters more than maximum growth. Low to moderate risk. This level creates a middle ground between protecting your money and giving it room to grow. Bond funds and conservative balance funds often fit here because they spread money across multiple investments instead of relying on one asset. Picture a basket carrying sturdy bricks and a few growing plants. The bricks provide stability while the plants offer more room to develop. Diversification can reduce the damage caused by one investment performing badly. Still, the fund's value can move, especially when interest rates or markets change. You may see smaller ups and downs than with an all-stock portfolio, but the trade-off is also more limited growth potential. For investors who want something between a savings account and a stock-heavy portfolio, this middle ground can be appealing, especially when avoiding extreme swings matters. Moderate risk. At this level, you are accepting noticeable market ups and downs in exchange for greater long-term growth potential. Balanced portfolios and target date funds often combine stocks and bonds, giving each side a different job. Stocks can provide growth, while bonds can add stability when markets become rough. Think of it like driving with both an accelerator and brakes. You want progress, but you also want something to help control the ride. The key advantage is time. A market drop can feel painful over a few months, but investors with longer time horizons may have more opportunity to recover from temporary declines. Recovery is never guaranteed, and diversification cannot eliminate losses. The idea is to avoid depending on one type of investment. For many long-term investors, moderate risk offers a practical balance between growth and stability. Moderate to high risk. Here, a larger share of your money is usually exposed to stocks, so your portfolio has more room to grow and more room to fall. Broad index funds and diversified equity funds can spread your money across many companies, rather than making one company responsible for your results. Imagine owning tiny pieces of hundreds of businesses instead of betting everything on one store. That diversification can reduce company-specific risk, but it cannot protect you from a broad market decline. When stocks fall, your investment can fall with them. The upside is stronger long-term growth potential than many lower-risk assets, although past performance never guarantees future results. This level can make sense for investors with longer horizons who can tolerate temporary losses. The important distinction is simple. Diversification manages risk, but it does not make stock investing safe. High risk. This is where investors lean more heavily toward investments with larger potential gains and losses. Individual stocks and sector investments are common examples because your results can depend heavily on a particular company, industry, or economic trend. Imagine choosing one restaurant instead of owning a small piece of the entire food industry. If that restaurant becomes a hit, your investment could soar, but a major problem could hurt you quickly. Research can help you understand a business, but it cannot predict every surprise. A strong company can face lawsuits, new competitors, changing technology, or an economic slowdown. Concentration makes those events matter even more. The attraction is obvious, higher potential returns. The downside is equally important, larger losses are possible. High risk is not automatically bad, but it demands a greater ability to handle uncertainty without making emotional decisions. Very high risk. At this level, extreme price swings become a normal part of the experience. Crypto, speculative stocks, and concentrated positions can move dramatically because their values may depend on sentiment or uncertain outcomes. You might watch an investment jump sharply in a short period and then watch much of that gain disappear just as quickly. That is what makes speculation different from long-term investing. Instead of mainly relying on a diversified portfolio and time, you may be accepting a much larger chance of permanent loss. A concentrated position can be especially unforgiving because one bad outcome affects a large portion of your money. Some investors deliberately accept this risk for the possibility of unusually high returns. The key question is not how exciting the upside looks, it is whether you can survive the downside. Extreme risk. Here, risk can be amplified by borrowed money or complex strategies that make small price movements much more powerful. Leverage and certain option strategies can turn a modest market move into a large gain or loss. Imagine controlling a much larger position than your cash would normally allow. Every move now has a bigger impact. That can make profits arrive quickly, but losses can accelerate just as fast. In some strategies, you can lose most or all of the money committed, while certain forms of leverage can create losses beyond the original amount. This is very different from simply owning a diversified stock fund and waiting for long-term growth. The potential reward may look attractive, but the risk operates on a completely different scale. Extreme risk strategies require a strong understanding of how losses can compound before anyone considers the possible upside.